Well, hi everyone, and welcome to the InvestSMART Bootcamp webinar. And this is week 4, which is covering off modules 5 and 6. So it's the final modules and the final week of webinars. But that's of course just our own time frame. You can rewatch this and go at your own pace. So hopefully you're not starting it at this one though, because some concepts may be a little bit unusual or a bit different. So definitely recommended to go back and just watch some of the older webinars that precede this one. And they're all available on the bootcamp, and we'll always add the new registration section within the modules as well for next week. So I'm Tom Wilson. I'm one of the product specialists at InvestSMART, and I look after bootcamp at the same time. So disclaimer, first of all, just remember that we can't provide any specific financial advice, just general only. But have a read of that. It's something that if you do ask a question, I will either rephrase it or may not answer it during the webinar if it's going to be like specific financial advice. So how do these webinars work? Well, they cover off any questions from the learning material. So as you're going through, if you do have any questions, on the right-hand side, using the GoToWebinar control panel, there's a little questions box, and you can definitely pop in a question there, and I'll get to it, even if it's a comment as well, or any feedback, definitely pop it in. Very happy to cover off whatever we can during this. As mentioned, there's no financial advice given. I can always try and reword the question, especially if it's going to benefit everyone else. We need to stick to the course content. So this is covering off modules 5 and 6. So we'll stick to questions relating to that. If there are any questions about previous content, I'll either point you into that direction or see if I can cover it off, particularly if it's got relevance inside this webinar. It also serves to make sure that you're using the resources that we have available. So we often refer back to Intelligent Investor and Eureka Report. There are other resources that InvestSMART has as well, such as the Portfolio Manager, which we'll touch on today, but also calculators and different other filter tools such as those. And just remember, this is an introductory course. It's just covering off the basics, so it's not going to be anything too complex like a university course where we'll dive into any ratios or anything too difficult. So, you know, if you do have a question that is quite advanced, I may get back to you after the webinar instead. So I'll just skip. So basically, it's good to recap and just go through what we've covered off so far. So week 1, it's more about the planning stage. And we're talking about how I have the goal of saving for a house deposit. So you always need a goal. You need to know the time frame in which you can achieve that, or that it takes to actually make that goal a reality, and also how much risk you're comfortable with. So in my instance, saving for a house deposit, I've given myself a realistic time frame of 3 years. So anything that I want to choose needs to be within that 3-year time frame. And the risk, well, I'm comfortable with risk, but I don't want to go backwards. So I'm not going to choose something that's quite volatile, going to go up one day and down the next. I'm going to stick with something fairly defensive, and that will be able to give me a return within that 3 years. So how will I do this? Well, I'm going to diversify. I'm going to spread my risk. I'm going to put my investment money, my hard-earned saved money, into something across different asset types, not just into the one actual asset. And then in doing that as well, what kind of percentages do I want to allocate to different assets? Like, do I actually want to put 50% in shares, 50% in savings, like a high interest or fixed income? So that's quite important. Obviously, if I went 50% to shares, that's fairly growth or aggressive type approach as opposed to a defensive or conservative. And week 2, we looked at the different types of investment vehicles, just a fancy word for things I can invest in. And we looked at shares and ETFs, which trade on exchanges typically, such as the ASX, Australian Securities Exchange. And then we looked at managed funds and portfolios. So having someone else manage your investments for you. There's pros and cons to that as well. And then looked at cash and bonds. So basically risk-free assets. You get a much lower return, particularly at the moment, given interest rates are so low, but there's essentially no risk that the money, the capital that you first invest, won't be returned to you. The week 3, so last week, we looked at a few different investment strategies and we covered off the difference between active and passive, core and satellite, value investing. We looked at some technical analysis along with income and income-based strategies, but also market timing. So basically, to sum it up, what do we know so far? Well, we know that we need to have a plan. That's probably one of the most important things we need. If we don't have a plan, we don't know where we're going. So we also need to understand what we can actually use to complete that plan. So we need to know what kind of investments or what kind of assets we can put in there that's going to help us grow, that aren't too risky and that are in line with our time frame. But we also need to understand the risks that are involved with those assets, but also the time, so the costs in doing it. If we're just going to go out and buy and sell shares every single day, pretty soon there's one person who's going to be rich, and that's the broker. You'll be paying them anywhere from $5, $8 up to $20, up to $30 per trade. And that pretty much eats into your returns very quickly, especially if you're doing small size trades. We also need to know what kind of strategies we do have available. There's always new strategies out there that you might hear of. The tried and true ones tend to be the satellite approach. So basically, you've got core and satellite where you have a passive core and you're on the outside, you have some little active type approaches. So week 4 is all about investor psychology, along with talking about putting everything we've learned into practice. Investor psychology, I find this quite interesting, even personally. My background is that I first was at uni doing a commerce degree, got involved with trading and investing. And when I was doing that, I found that there was so much psychology involved, particularly with the trading aspect in terms of dealing with high pressure, why we make the same mistakes we do as humans when it comes to trading. And I went back to uni and I did a psychology degree as well. And now I'm lucky enough that I can combine the two and deliver these webinars and working at InvestSMART, helping people, I guess, grow their wealth. So definitely remember that you've got the opportunity here to ask questions as we go. I'll keep an eye on it, but definitely any comments as well. So in the bootcamp content, we know that it talks about what holds you back, what tempts you to invest, the biases that we, I guess, are prone to, and also the common mistakes. And we'll discuss them briefly here. So what is holding you back? Is it a missed opportunity? So a lot of investors that I speak to, particularly at the moment with the COVID pandemic, and also previously with other, I guess, market events that, like around Brexit or even during the GFC, things like that, there's always an element of uncertainty. So you need to accept that first and foremost. And one of the ways to get around that is that if you do have a plan, it's best to stick to it. So definitely have a plan and understand your time frame. It's okay to adjust it if you need as you're going through, but try not to make too many big changes, because then you're just essentially following any kind of news that as it comes out. You want to have a long-term plan that takes into account that, depending on the assets that you've chosen, they should be suited to that time frame itself. So shares, for example, they tend to be volatile regardless of what area you're investing in. So they tend to dictate a longer time period anyway. So 3+, 5+ years just for shares alone. So none of us like losing. It's definitely a feeling that I still myself, I don't like it, but I do understand that it is part and parcel of investing, that you can't be right 100% of the time. It's impossible. That you also maybe just keep in mind the worst case scenario and then plan for it. So if you did have an investment that, particularly a share that might go down 50%, what does that actually mean? Does that mean that you'll need to draw on money somewhere else? Or is that something that in the long-term plan you've got that's expected, but you also have an idea or information that it might be going back up to where it was? It just depends. That whatever does happen, just try and think about the worst case scenario and also plan for it. And that may mean keeping some extra money aside, which we do discuss in the boot camp as well. So this is the other side of the coin, I guess, is what tempts you? Are you jumping straight into something without properly thinking about it? Impatience is a big thing to do with trading. So we see a lot of research as well that a lot of investors or traders that overtrade, as in they might think that they're a day trader and they like to buy and sell the asset the same day and get out, get in and get out. That definitely does rack up the transaction fees like brokerage, and even a lot of trading platforms. So I used to work at a broker myself. We had a lot of clients where they would trade gold, for example, or they would trade shares, or they would trade cryptocurrencies. And a lot of those don't have a brokerage fee, but the investment company or the CFD provider or the broker, they will make their money sometimes through the spread. So the difference between the buy and the sell. So they'll actually put on a few extra pips or points, and that's how they collect their equivalent of commission. So with overtrading, it's shown that people who overtrade, they actually don't perform as well as a person who doesn't trade as often. So someone who sits there and chooses what they need to do in line with their plan, invests for a longer term, they will tend to do better in terms of a better wealth growth for them based on the research. So the hard part is that we actually are wired as human beings for this effect. We actually get a hit of dopamine each time that we buy and sell when we see something, I guess, go up in value, and it does get exciting. A lot of the trading companies, such as the leverage ones like CFD providers, they do have this in mind. It's very akin to gambling, and they do try and make their platforms quite flashy, quite exciting, so that you do want to jump in there and trade or overtrade. There's some really interesting videos on YouTube called Dopamine Detox, and it's basically a good summary of how nowadays we've become a society of wanting instant gratification. Everything's at a click of a button. You can get food delivered, you can track it, watch it come to you. You can get angry when it doesn't get to you on time. Same with investments, all online nowadays. It's very unusual to have a paper type based one, so you can watch your investment, how it's going through the application process, and then also when it's there, long term, you can check on it day in, day out, which is usually not the best thing to do. It's usually best to invest if it's in line with your plan, and then you let it do what it needs to do over time. So the dopamine detox, they talk about how to actually start to break away from things like that. And they use different exercises that I think can help you not only with investing, but also just in your general life as well. But again, come back to, it's good to have a plan. You need to update it when it's appropriate, not too reactively, but the plan is the most important part. So the biases that we've covered off in bootcamp they are quite numerous, and there's so many different types. It's not an exhaustive list. You just probably read through them, and you'll probably identify some that you've perhaps made yourself or you've seen in other people. I know with myself and my background, speaking to a lot of investors and traders, I can almost tick every single box on there. And it's just how we are as human beings, but being aware of it and also looking at some of the solutions in there that can help you to get around that. So the biggest mistakes that I've seen in terms of talking to investors and traders is first and foremost, not having a plan. So there'd be a lot of people who would ring up and talk to me and say, I've invested in this, it's gone the wrong way, you know, what can I do? And you'd say, well, look, why did you invest in that? What was your actual plan? Was your goal to make a return of this over this many periods? What were you trying to achieve? Was it just growing wealth, or was it for a holiday? And very often they'd come back with just, oh, I just wanted to get rich, or I just wanted to, you know, not have to work every day and instead be a trader or be an investor. And that's not really a good enough plan. It's very pie in the sky type thinking, where it's great, it'd be fantastic to be a trader full time, but it's just not realistic sometimes. And unfortunately, even my background, when I've seen that happen, it's very, very rare. So the plan's the most important part. The second part is actually record keeping. So a lot of people might have a plan, but they don't actually record how their investments are going, or they don't regularly review that. There's a few little tools you can use. One is the portfolio manager, which InvestSMART offers for free, and that's on our website. We'll touch base on that a bit later. Diversification lacking is another mistake, unfortunately, where you tend to see in perhaps an older generation of Australians in particular, where they'll invest solely in Australian shares. In a previous webinar, I used my grandfather as an example, where he would always invest in the big Australian shares that perhaps were getting listed, like Telstra or Commonwealth Bank when it first got listed. And they thought that just owning those was enough. But whenever the ASX itself had a bad day, for example, then their portfolio would have a bad day as well. So that's one issue that a lot of people don't understand. And diversification can be a bit of a scary word. It might even be something that people think is in the realm of finance, or the people who wear suits, expensive suits, and they talk about diversification. And it's not the case. You can get easily diversified with your investments, just even by using ETFs that trade in the market. And we have spoken about that before. So hopefully doing this course, you've learned the importance of diversification. Panic is also, unfortunately, something that we've seen even recently. A lot of investors who, at the first sign of the global pandemic and the big drops that came with it, took their cash out of a lot of different investments. It's a bit annoying, because you do see that investment then go back up to where it was, if not even go higher. So if you had have done nothing, you would have earned any kind of income off that at the same time, such as dividends or interest payments, that you'd also avoid transaction costs, so jumping in, jumping out. And I guess that just comes back again to not having a plan, or not sticking to your plan. If you do have a long-term goal, you should take into account that this does happen sometimes, but it's in line with my plan. I've chosen the right risk, so there's no need for me to react suddenly and panic. You also see a lot of people becoming too conservative or too aggressive. So some of my friends, for example, they're in their early 30s, and some of them have got windfalls from whether it's selling a business or perhaps receiving a redundancy, and they get a lump sum of cash, and they often ask me, what should I do with it? And in line with the bootcamp, I always go back to those three things: goal, time frame, and also risk. And you tend to find that some of them will have a very long time frame, which is almost ripe for a bit more of an aggressive approach that you could put in for a longer, a better return, a bit higher risk. They themselves are someone who are very conservative. They don't like the idea of losing even $1. So what they'll do is they'll put it into something very, very defensive, like a term deposit or even a high interest savings account, which is extremely conservative. And unfortunately, there's a lot of opportunity costs. So you're missing out on the potential of much more growth compared to someone else. But then on the flip side, I've also had friends who have been quite aggressive, might have very short time frames, less than a year, but then we'll put them into something that might deliver a higher return but carries much higher risk. or even worse, they'll put them into assets that are highly speculative, such as cryptocurrency, foreign exchange, or even gold that trades on CFD platforms. And usually the next time I talk to them, I hear they've had a big loss. So a lot of them do take my advice though, and they do stick to that plan, timeframe, goal, and risk. And those are the ones that we tend to see longer term do much better. There's an interesting question I had come before this webinar, and it was from Kenneth. He was talking about, are there any more recommendations, whether it be books or websites that we can learn about investor psychology? And these are the ones that I myself have gone through and read, and I could say that they do have a lot of help inside them. They provide usually like a theoretical breakdown of why we do certain things, which can be a bit dry at times, but when it comes up with the solutions at the same time, that's when they definitely prove their worth. So the first three are very much linked to trading or investing. Trading in the Zone by Mark Douglas, the third one there, is quite interesting, and it does help you develop a good disciplined approach. The Market Wizards book is one that is often recommended by a lot of well-known investors, and basically he interviews a lot of traders within there and talks about what they do to be able to be successful. And it's very interesting that they themselves all have plans. They do make mistakes, they do have losses, but also reading about how they deal with it. The last one on there is Daniel Kahneman, who has written Thinking Fast and Slow. So he's a psychologist, and I believe he won the Nobel Prize for economics. He has a lot of followers in terms of investing, and even John Addis, who is the original founder of Intelligent Investor, that's part of the InvestSMART company. He's a big fan of Daniel Kahneman. I had a really long chat with him when we were putting the boot camp together, and he goes through his book talking about the different speeds in which the brain processes information, but also a lot of those biases that we do cover off as well. And it's very interesting because there's some interviews, you can Google this online. Daniel Kahneman is actually quite against active investing. So he doesn't believe that that's a good approach, more of a passive type approach to investing. But I know that you can get audiobooks of these, hard copies, and also Kindle or electronic type versions. So definitely have a read. Some of them can be a bit long and dry. The Market Wizards is just fun to read, different perspectives from different successful traders. So the other part of this is you've learned a lot of information so far, but what's it actually mean? So does it mean that you are ready to go out and start trading now and start investing? To an extent, you've got an idea, an overview of how different things work and perhaps a sensible way to go about it. You're definitely going to be a couple of steps above the average person in Australia, particularly, who doesn't even know what diversification means or what even the word or acronym ETF stands for. So hopefully you've got a better idea. As always, the next steps are definitely do a plan. So hopefully as you've gone through, you've done that and you've put together a plan of what your goal is, the time it takes to actually achieve that, and any kind of risk that you're happy to take to get there. Maybe you can have different goals, but you need different plans. The best way to do a lot of this is to use the portfolio manager, which I was talking about before. So I'll just show you that quickly where it lives. So it's on the InvestSMART website. And if you go to my portfolio, so on the black bar, this is my test portfolio. So in the portfolio management team here, we have a competition each year where we have to choose a stock, and you have to choose one stock on the Australian market that has corresponds to a letter of the alphabet. So it's an A to Z. And we started off obviously with $1,000 into each one, which is like $26,000. And we just key in here to track it. So far mine's up, which is a good thing. But what you can do yourself is you can actually create your new portfolio, and you can go through and add all the assets that you own. So most Australians, what they find is when they do this, they will then choose what kind of approach they'd like to take. So you can actually get a health check here as well, and that compares you to what kind of holdings you should have in terms of what kind of assets you should be allocated in, depending on your portfolio type. So if you said I've got a goal of, like me, saving for a house 3 years, so it might recommend like a conservative type portfolio. And if you've got a lot of your cash, a lot of your wealth tied up in shares, particularly just Australian shares, it would give you a rating here in the health check, and it would let you know that you're overweight or underweight in different asset classes. So this is an example in my hypothetical portfolio here. I can see my current holdings, and I've got various different types. So for example, starting with the letter A, I've got the A200, which is an ETF. So that gives me exposure to a number of different shares within that. And I've also got some other ETFs in here as well. So this is by no means a recommendation. A lot of it is just random, to be honest. But what I can do with this portfolio manager is that it'll actually even break down what holdings have international equity exposure, and it'll give me a list as well. Some of them have exposure to property, some to cash, but you can see with a lot of those, I'm actually underexposed to that area compared to what I should be, which is the target I've chosen here. So you can key in even the family home, and then if you don't wish to have that considered to be an asset, it can actually be turned off. With all the different managed portfolios InvestSMART have, they'll appear in here as well. You can have dividend reinvestment plans turned on, so it tracks it. And this is completely free. We don't charge this for anyone, for any client or anyone wanting to just use the portfolio manager. So you can have multiple different portfolios. That's usually in line with your different goals. You can see here I've got the growth 5 to 7 chosen. That's what it's trying to match against. It's a very good way to track your investments and keep on top of them. So there's a number of different approaches you can take now that you've got an idea of investing generally. I will talk about the the InvestSMART products, just given because I'm more familiar with them as opposed to others. But our website, particularly on the Intelligent Investor Eureka report, they do go into other investments that you might consider through different companies. So definitely do the research there as well. But as you've probably seen with module 6, there's a number of different ways that we find that clients like to use InvestSMART and its companies within it to grow their wealth, or at least to manage their investments. And the first one there is letting it be done for you. So we take care of all of the investing side of things in terms of the reporting, and that's through managed portfolios. Now, InvestSMART has its own managed portfolios, which they are diversified, and they also have capped fees. So they're going to keep the costs down for you. I'll quickly show you where they live on the website so you can do your own research, but it's on the InvestSMART website here. And if I go to invest with us, and there's unfortunately the doorbell, which is one of the privileges of working at home during lockdown, but I'm sure they can come back later. So you've got here the diversified portfolios, and they're ranked in terms of the different risk type that we're happy to go with. So they also have their own timeframes, which is suggested here as well. And what these are doing, they're investing, say if I looked at the growth portfolio here, what they're going to be doing is allocating our cash that we put into it into different asset types. So international Australian equities at the top. So straight away we know that's going to be close to 60% of our cash towards, I guess, assertive or aggressive type in assets such as shares, which are usually higher risk but higher return as well. And the way that we do this and keep the costs down is that we purchase ETFs that trade on the ASX, and that gives us exposure to those underlying markets. So we can go out and buy just one ETF, which for example is the iShares Australia 200 with the ticker code IOZ, and that automatically gives us exposure to the top 200 Australian shares on the market. So because of that, it keeps the fees down. So it's a minimum of $99 per year to have InvestSMART manage this for you. And then it's on a sliding scale from 18,000 up to 82, which is 0.55%. But as soon as you reach $82,000, and that's across any of the InvestSMART portfolios, so you might have different goals, different timeframes. You might have some cash in growth, some cash in high growth, some in balanced. They look at the total amount, and if that's above $82,000, then your fees cap out at $451 per year. So you might have, it's a good problem to have, but if you had $1 million, then you'd only be paying $451 per year. So with that, InvestSMART manages the investment for you. They do the tax reporting, so they provide you with the tax statements at the end of the year. They do the dividend reinvesting, or if you choose to have the income paid out to you instead, they'll manage that as well. You can also top up your account as you go with regular direct debits. On the flip side, you've got the intelligent investor, and they have their portfolios here as well. So at the moment, they've got equity income, equity growth, Australian growth fund. So these are their managed portfolios, which means that if you were to invest with them, they will do a similar thing where they will manage it, put it into different sectors, into different shares, but because it's active, there's a team behind this where they're actually buying and selling when they need to based on their own research. Because of that, there's no capped fees. They have a sliding scale here, which is just a percentage based on the amount you put in, but their job is to try and outperform the market. So with the InvestSMART ones, they're happy to get the market return plus any fees. There's not much, well, there is work that goes into it, but it's not as intensive as something like this. But this is why we talked about in previous episodes of this, and also from the bunkers that you might have seen as well. It's good to have an approach where you could have a core and satellite. So at the core, have passive type investments, and then at the satellite side of things, you could have more of like a aggressive or perhaps even active type investments, such as something like this. They also offer, you can actually hop onto your broker, like the ComSec or whoever you use, NavTrade, and they've got some of their funds here listed. So you can buy and sell these like an ETF, and the code is INIF for the equity income, and then the ethical share fund is INES. And you may have seen that they're in the process of listing the growth fund. So that's going to have the code IIGF. And I believe tomorrow you'll see some more information on this website about how you can take part, because it's going to be limited to $100 million. The unit price is $2.50 to buy. And the thing about the initial offerings, like you'll see tomorrow, is that you don't pay brokerage. That cost is actually paid by Intelligent Investor to get it listed. So that's like an approach. If you wanted us to manage it for you, you would just basically apply for an account, deposit the cash that you wanted to have invested, and then we would take care of it from our side. The other way you could do is a mixture of both. So you could still have that kind of managed side, but then you could also follow recommendations from Intelligent Investor. So you could use your own broker such as CommSec, and you could buy and sell shares that are recommended to you. Intelligent Investor is one example, but there are heaps of other companies that recommend stocks as well. And there's also Eureka reports. So Alan Kohler interviews each week the CEOs or the founders of companies. That way you can get the behind the scenes story as well about what is happening. The Eureka report's quite handy. I find it invaluable in terms of just reading about different assets. So there's talking about ETFs this week, which Alex is writing about. And then there's the real estate investment trusts, which are going to be quite important at the moment, given that we're slowly unwinding restrictions around the pandemic. The buy now, pay later is always a very interesting topic. And it looks like Alan's had an interview there with one of the founder and managing directors. So CEO interviews, and there's other topics as well, particularly Elizabeth Moran. She talks about a lot of the fixed income and bonds. So I always refer people to this website when they need to find out some more information about those particular asset types. Then finally, if you did it yourself, the recommendations that we were talking about on Intelligent Investor, which I'll just go here, and you can see the latest recommendations or look at all of them. And what they'll do is they'll even provide what kind of weighting they should make up of your portfolio. So they provide that on the side here as well. So if you were someone who said, I'm just going to have, I've got the passive side looked after already, I just want to have the active side, which I'll do myself, you could use this as an example and say if that recommendation was to hold, you could then click on it, and 2 hours ago, they've given a rundown on their result and why they believe that it is a hold. So you could be someone, if you've got time, you could read all this and go, yep, I agree. It's saying hold at $3.77. It's currently sitting at $3.81. So I'll just hold it at the moment until I get some more recommendations in the future. So basically just, I guess the key points to leave it with you is have a plan. I know I said that a lot during this whole webinar and even previous webinars, but that's, I guess, the keys to success. It's one thing that I've seen in my experience. Consistently profitable investors and traders are the ones that have a plan. That's something they've all got in common. They also diversify. They keep their fees down, whether it's going with a provider that caps their fees or they don't overtrade, so they don't rack up fees. And they also aren't afraid to get help if they need it. And that help can be through going to see a financial advisor, one that, again, has a charge for a service. So instead of charging you open percentages on things that you invest in or trailing commissions and things like that, they will go see them and pay them for that appointment. I mean, you've also done a very good thing in terms of you started this course and you're going through it. So there's also, I believe, a responsibility to let other people know that financial literacy is something that we can still teach ourselves. It's not really taught to us at school, or at least in my day, and I believe it still isn't as much. So it's definitely important to let other people know of the concepts inside courses like this. Paul Clitheroe, who's the chairman of InvestSMART, he sits on the financial literacy board for the government. So he's very keen, as am I, to definitely push this financial literacy to all Australians. So definitely recommend this course or others if you come across something that's helpful, or even just give them a rundown yourself. That's something that we think is a great idea. So we've reached the end, and there's oh great, there's a question here from Anthea, just about how are the percentages determined in their recommendations? That's a really good question. they do talk about this. If you go up to recommendations and go to value investing, they give us a bit of a rundown as to why. Essentially, here we go, portfolio weightings here. So it's, I guess, essentially a best estimate. You don't have to follow that, but what they're saying is that it's for an average investor. That's the kind of exposure that you'd like to have in a portfolio yourself. So if you're someone perhaps who has a portfolio split up across different kind of investments, you may want to rejig it, and you may want to say half it, for example. I think they even say it here. It says often it makes sense to buy much less than recommended maximum when we first recommend a stock, perhaps half, to give room to increase your holding if it falls further and becomes better value. So they also talk about that if it does go above your maximum holding, and to reduce it to keep you in line. And that's very interesting because it's one way in which that if you are going in and you're going half of the recommendation, the percentage, it's essentially helping you to dollar cost average. So you're getting in slowly and potentially maybe at a lower price, but even if it is a higher price, if you're doing it in dribs and drabs, then you'll average out the cost of your entry. And then when they talk about even reducing size, if you do go over the maximum, perhaps because the stock has gone up, then that's a really good way to rebalance. So you're rebalancing your portfolio, and at the same time, you're taking any kind of profits off the table as well. And there's some interesting webinars that even our CEO, Ron Hodge, has given, showing the effect of the rebalancing over a period of time, where essentially, because it's going well for you and you have to reduce the holdings, the size, that it helps to set you up in the future when it comes to certain kind of crises such as the GFC or other things like that, because it's basically taking those profits and putting them into a diversified portfolio again. But that's a really good question. This section here, I don't know if it's highlighted enough by Intelligent Investor, because we do get a lot of questions from people talking about how the recommendations work or how the price guides, and they have written quite comprehensively here. And they even talk about what they mean by buy, hold, and sell. And you'll even see others that say speculative buy or speculative sells as well. So that's a very good question. Thank you very much for that one. So basically, just to wrap up, you can always ask questions after this if you like, and you can just email bootcamp@investsmart.com.au. There's also on the website, you've probably seen a little chat box bottom right-hand side, which is a salmon type color. You can click on that, and there's usually a human being behind the scenes there answering the questions. So usually 9 a.m. to 5 p.m. we'll be doing that. But apart from that, you've probably seen this, but congratulations, you've reached at least the final webinar. So definitely keep reading and finish off the actual content itself. But remember, if you've got feedback, any questions, definitely let us know. There's a course review at the end of the bootcamp, and we'd love to get your feedback, particularly if it's quite positive, so we can let others know that it's worthwhile doing. And this is always evolving. We're always adding new stuff, particularly once we get a lot of the restrictions lifted. We're looking at putting some more videos on there as well. But until next time, thank you so much, and stay safe and have a lovely weekend.